Okay, so in your recent report, you wrote that the dual archival price highs at $50 back in 1980 to 2011, this is referring to silver, are archival relics, and frankly, only important to price chartists who think taking them out is important. In real dollar terms, silver would probably have to enter the hundreds plus to begin to match those old highs, which wouldn't surprise us in the coming year or so. So triple digit silver. So I want to get your perspective there and dive into that a little more. So people often look back at the price charts in the 1980s and 2011 and looking at taking those out, and chartists often look at the support and resistance there and such. And so you're saying that that's irrelevant, right?
I think it's really irrelevant. Yeah, as I said, so many years have passed that the real value of the money unit that we're measuring by, the dollar in this case, or you could do it with euros or anything else, is just meaningless. The decay in the dollar has been so great that, again, to match the real converted value of silver in 1980 at $50, you'd easily have to be a couple $100, maybe more. And in even 2011, you'd well over 100, I'm sure. So those are really sort of jokes, and our assessment is that, one, I don't know how high silver's going. I think it could go into the hundreds, 100 to 200, would not surprise me. But we're taking it in segments, and my own personal investments, which we show at the end of each report, the disclaimer, are heavily in silver miners as opposed to gold. Okay, though gold is the mama, it's going up. Silver has both outperformed and underperformed gold on a routine basis over the decades. And if you go back 50 years and look at what is the highest relationship of silver to gold in any one of those given years, and plot it. We have a graph we put in the latest report. 2%, meaning divided ounces silver into gold. Silver was 2% of the value of gold in 20 of those 50 years. So it's not absurdly, to be unexpected to see silver at 2% the price of gold. And in fact, in bull trends, like 1979, 1980, 2010 and 11, silver got up to 3.5 and higher the price of gold. Well, right now, silver's 1.12%. Okay. Still dirt cheap. It got under 1% recently, which is historically very, very low level. When you see that, buy it. But when that spread turns up, and it's been turning up sharply, well, just for example, this year, people don't realize this. Silver's up 42% on the year today. Gold's up 37%. And yet most people still think silver's lagging. It's not. It's catching up to gold. And there are certain technical levels not far above where we're trading right now that if silver spread versus gold can reach those levels, the spread chart and the momentum of the spread chart, which is what we look at, both technical metrics, have very clear pending triple top breakouts, meaning levels that they've stopped twice before. And if you punch up through that, these levels go back several years, by the way, you're breaking out big time. So if you looked at these charts, these spread relationship charts, and treated it as a price chart, you'd say, oh boy, you break through that and I'm going to blow the cork off this thing. The spread is about to do that, I think. And when it does, I think in the next handful of months, between now and the end of the year, silver's likely to be in the $60 to $70 price range. And I think the surge will also carry us highly likely to a 2% level, which again is routine. Well, that's a huge move because we're talking almost doubling the current relative value of silver to gold very rapidly and going up to that, quote, normal 2% level. Because we're, like I said, 1.12% right now. So anyway, I think there's a huge explosive potential in silver, coincident with the rise in gold, but advancing more so. And so that's why my personal emphasis is in the silver aspect of the monetary metals.
Got it. Okay, so just thinking about that, I mean, obviously you look at momentum. I do want to get your perspective, if you have any perspective on fundamentals. So obviously with gold, we see central banks buying and such. What do you think of those fundamental aspects of for silvers?
Well, first off, I don't look at it that much. And I try not to, okay, because I don't want to be distorted by a notion of fundamentals. Why? Because quite often fundamentals, even if they're true, even if your assumptions are correct, that doesn't tell you about the timing. You could be right and not be right in terms of price reaction for 2 years, okay? You know,
Yep.
do you remember the movie The Big Short?
Yep.
The guy, these 3 or 4 analysts around the country, different guys, didn't know each other, all came up with the same conclusion. There's going to be a mortgage crisis. There's no way around it. They pounded the table, okay? That was 2005, 2006. And it wasn't until late 2007 that the stock market finally topped. And it wasn't until 2008 finally that they said, I was right. So you get the point, fundamentals, okay. Silver does have certain unique, we know the industrial aspect. It used to be, you take a picture, that silver was a key factor in photography. Now it's a key component of solar cells. And it's also, as I understand, essential in the big AI explosion because silver is such a good conductor. Okay, well, the numbers that I've seen, and I don't know the validity, they probably are because I see them from too many places, of supply demand on the industrial side is very tight. The annual production of silver is not increasing, it's plateaued, and demand is continually increasing. And by the way, China is one of the chief demanders of silver because they're like 80-90% of global solar production, solar panels, which silver is essential. So anyway, that could become a factor where, let's say we cross 50 and CNBC needs an excuse to explain it, okay? And that's a good excuse. Oh, well, the industrial demand, well, that's true now, but sometimes it takes a while for that reality to finally be used as the excuse. The bigger issue is silver's money, just like gold. A lot of people like to treat it as not monetary metal, but as history shows, it has been. In fact, the U.S. has had silver as official money, too. So I think the crisis we're facing in global assets, global suffering, economic suffering, not just U.S., is going to be such that you're going to get a lot of things thrown up in the air in doubt, where you doubt the validity of a certain institution to provide what it's supposed to provide, like the central bank. You suddenly realize the value of the stuff in your wallet is decaying so rapidly it's ridiculous. As I said, your grandfather, father, and you, house cost, loaf of bread price when I was a kid, it's no longer 20 cents, okay? Anyway, there's a point at which the pain gets so bad that it's 52 card pickup. And I think the stock market will be a big key in that. Why? Because right now, if you look at, let's say, the average guy who's got a retirement account, maybe it's through state government pension fund or whatever, if he looks at it nominally and it's been going up because if it reflects the S&P, then it's been going up. Okay. Not a lot, by the way, over the last year, but, single-digit percent still. It's the only thing he's got to smile at. Everything else in his life is questionable. Cost of things are going up, et cetera, et cetera. And when that goes down, then it's, oh, hell, what's good? All you need then is some layoffs, et cetera, et cetera. And suddenly the average guy, instead of a sense of expectation, is a sense of doubt. And that creates fear. And when you create fear, the tone of markets change. And that's when institutions can get overthrown, ousted, abolished. And so it wouldn't surprise me that in a year or two there's no Federal Reserve. If the economy gets bad enough, which I suspect it will, there may not be any income tax, simply because it doesn't function. They go to a sales tax, etc. All kinds of things can change in big ways. I think that's the kind of situation we're facing now, pending.
Yeah. And so those big disruptions are definitely, in my opinion, are going to be bullish for metals and such. Mm-hmm. What about for Bitcoin? Many people feel like Bitcoin is a hedge against inflation, as well as that it's real money and that it could be complementary to gold. And so I just want to get your perspective there.
I understand the thought. When it originally came out on futures, which is December 2017, we started analyzing it routinely, and we've called every major up and down move in Bitcoin fairly well. fact, we got bullish in, I think it was 22, 23 when it was coming up through 20,000 after having a big drop. But the technical works that we do on Bitcoin, now that we look at the price chart like everybody does, and you think, oh man, it's going up forever. Bitcoin now moves, we ran a chart of this, I'll talk about price first. You can overlay a monthly bar chart of Bitcoin futures on top of a monthly price chart of the NASDAQ 100. They are the same beast. They inhale and exhale in sync. Not day to day, but usually month by month for sure. And Bitcoin, for example, had a puke into April, just like the stock market. Bottomed the same time, turned up, went back to the high, nudged out a new high. Okay, it had old highs around 110,000 late last year, and early this year 110,000. Then it had the drop into the mid 70,000s, came up through the 110, went up to 125,000. Everybody thought, oh, it's going to go to 1 million. We all know this, okay. And Trump's in it too. He's getting rich, okay, in crypto. Notice what it did last month. Came back and closed the month out below 110,000, meaning this process that it's had on price of layer of selling, then break through and surge, pull back, hold the support, go up again, break through that last ceiling. This time it came back down below that last ceiling and closed out a month, indicating that breakout above the plus 110,000 level didn't hold. Right now we're trading around 110,000. When we run momentum on Bitcoin, our primary emphasis of analysis, quarterly momentum, 100-week average momentum, what that means is we're taking the price action and measuring it, whether it's above or below, and oscillate it as an oscillator compared to that moving average. And we get a different technical picture than when you simply look at the price chart. And what we see on Bitcoin, and I've pounded the table on this, we're not triggered it yet, so don't act on it. When you get into next quarter, the 3-quarter moving average of Bitcoin will be adjusted because it's a new quarter. We'll jump up to about 101,000. Since 2022 upturn, 2023, it's pulled back 3 times before to that rising 3-quarter average, meaning on the oscillator, you see this repeated drop down to what's the zero line. When you look at the momentum chart, you see a floor from hell. You better not break it. It's an exact overlay of 1987 S&P prior to its crash. It has crash dimensions, and the number this quarter is down in the 91,000s, but it's going to adjust up in 3 weeks, next quarter, to around 101. And we've got some other long-term momentum metrics that agree with that, such that if you ooze back down, now we're 15,000 off the high, 125, we're now 110. Which is not a good idea to be where we are anyway. We got down to 108 recently. You get down around 101 again, starting next month, next quarter. You're going to be on that structure and you will not hold it. In which case, I bet that NASDAQ will also be dropping. Remember, they're coincident. NASDAQ and S&P do not look like they have crash events near term. In other words, they look like they could go down again, another major leg, but not a crash. That's like 30-35% in a matter of weeks. Bitcoin does have that attribute. And I think that would be a psychological and financial ambush to the stock market because so many corporations now are embedded in crypto. They weren't years ago. 5 years ago, it wouldn't matter if Bitcoin went down to them. Now they're entrenched in crypto. They believe in it too. And so you've got financial markets that are now linked to Bitcoin, not just speculators that are all frothy. And if you break that market in a manner that we think it could break, once you hit our trigger levels, that's the condition, watch out. That could be an ambush from the side that nobody's expecting. And that's when the guys who think that Bitcoin, being, quote, a non-governmental money, suddenly isn't a competitor to gold. And that ambushes them emotionally when that happens too.
Yeah, that's definitely something that folks should be concerned about. So, are there any other commodities that you're looking at that look good on a structural momentum basis? And
good
want to get
question.
your perspective there.
Commodity index, we use the Bloomberg Commodity Index, which is a fairly well-balanced index. It's not too heavily on energy like some of them are. Okay. It made a high in 2008 and again in 2011, coincident with gold back in 2011. And back then, those highs were 230 something on the Bloomberg and 170 something. Right now, Bloomberg, first off, after that, in 2020, after gold had already doubled, Bloomberg kept going down. So it wasn't in sync with gold. Gold doubled between 2015 and 20. Bloomberg continued down until 2020 and got into the 50s. Something was in the 200s, got into the 50s. So you call it cheap. That's a category that got cheap. And I'm talking, it was pretty representative. Crude oil drop, grains, etc. Since then, it rebounded. In October 2020, we called a bull move up. It went to 140. Still cheap, but it doubled. Okay? It's since pulled back 2023, 2024, and now to 100. And it's been dead asleep sideways for 2.5 years on the price chart. You look at it and say, gosh, nothing's going on here. It's not going down. It's not going up. When we go inside the Bloomberg and look at the key components like the grains or crude oil, for example, and do a momentum study of Bloomberg Commodity Index plus component sectors in the commodity category, we see pending upside breakout levels that look dynamic, meaning that as gold has been going up, commodities have not. They look like they're ready to join gold this time, which is exactly what happened in the late 1970s. Late in the gold bull trend, they suddenly said, we're here too. And they went up explosively while the stock market was going down, by the way. They look primed for that. Crude oil right now is trading a 61 to 65 zone for the last couple of weeks. WTI crude futures. Next quarter, I'll give you a number. It doesn't show up on a price chart as being terrifically important at all. $68 monthly close during next quarter, and I'm going to break out over a quarterly momentum trend structure that if you saw the momentum chart, which doesn't look like the price chart, you'd say, oh boy, I got to be long that beast if it breaks out. The commodity complex looks primed to turn up. It may wait a bit because quite often it's money flow issues. It's not just the specific fundamentals of corn or oil. For example, if the equity structure starts to break, money goes somewhere. If they perceive that commodity stocks and commodities are dirt cheap and not risky, because they're not going down, they've been living for 2.5 years sideways, money could flow into that category. And suddenly you could take oil up and not even need an excuse. It's just that it's too cheap, too long. I think that's about to happen. It hasn't happened yet, so don't jump the gun. But when we cross our various numbers, we're going to raise the flag and say, that's it, commodities are now joining in. Now that will create further upset to the average guy because he was promised that oil was going to stay down and that gasoline in the pump was going to stay low. Well, you take crude oil up to 68 next quarter and close a month there, it ain't going to stay low. You're going to get a sudden upsurge in gasoline prices. And that's going to upset, again, a notion of stability that isn't a stable situation. And that upsets people because, hey, if there's nothing true, then everything's up in the air. And what does that create? Panic, uncertainty, and sharp market movements.
Mm-hmm. So what's your outlook on the dollar? I mean, I can kind of make my assumptions now because just thinking of like hard assets such as gold, silver, commodities, and they're with the house of cards looking like it's about to tip over and such. I mean, that would mean a lower dollar, correct? And the dollar index, which is what most people look at, is 70% comprised of euro and yen. So what you're doing is you're looking at the euro and yen upside down, basically. Also the British pound, Canadian dollar, Australian dollar, etc. But the primary weight is the euro and the yen in that order. Okay. The dollar index right now is trading at 97.5 as we speak. Okay. You go back 10 years to December of 2015, when gold made its low at $1,050, the Bloomberg Commodity Index is where it is right now, 10 years ago. But you could draw lines sideways. Yeah, it's been above it and below it, but it's net for 10 years sideways, and yet gold has tripled in a half.
So if you're in gold, don't pay too much attention to what the dollar's doing day to day, week to week, or even month to month. But when it becomes a destabilizing factor, and for example, and the dollar index in 2023 and 2024 was dead sideways between 100 on the dollar index and about 107, 108. Got up to 110 briefly, but it was in a narrow 7% range for over 2 years. Totally dull, a non-factor in global money movement in terms of causing impact. In March of this year, it dropped back down to 104.21 after being up to 110, a fake breakout. Down to 104.21, has since dropped to 97 recent lows. We got bearish at 104.21 on a long-term basis. We argued that the dollar is now entering a major bear trend, dollar index, relative to these other pieces of paper, and is likely to go back down, even challenge its all-time low down in the 70s. Major move, in other words. So suddenly forex, major forex, which has not been an active mover for a couple of years, 23, 24, no movement, is suddenly now a player. Okay, so if you're a foreign investor and you invest in U.S. bonds, or you invest money in the U.S. stock market, as a lot of them have over recent years, if you get kicked by the dollar, S&P goes sideways, but you lose 7% in the dollar, you've lost that money because you have to convert it back to euros to enjoy it, So it can impact other markets. And it's not really gotten it speedy yet, but I think it's going to get speedy soon, meaning the downside become more noticeable. But we're major bearish on it, and I think it'll become a player again in world market movement.
Mm-hmm. Got it. Yeah, thanks for sharing that. So, Michael, as we wrap up, I just want to get just some of your take on just the indicators you use to measure this, because I think it could be valuable for the audience to check out your website and some of your research. But you use momentum, and so what is the reasoning behind that? Why did you find momentum to be the most important metric?
Well, I came up with the idea in the mid-'80s. I was a futures broker then. I became a futures broker after abandoning political philosophy as a profession in the 70s. Gold was legalized 75. I went to work for E.F. Hutton in early April 75, a couple months later in New York. I didn't know anything about charts. I knew about gold, but I didn't know anything about chart analysis. And my boss was also the chairman of the COMEX, headed E.F. Hutton's commodity division, and was chair of the COMEX at the time during those crucial years. And he taught me about how to use bar chart analysis, price chart. I caught the crash in 87 because what I'd been doing is taking the monthly price of the S&P bar chart that everybody sees and oscillating it, measuring it against three-quarter moving average, which is almost about the same duration as a 200-day or a 40-week average, whatever, a very long-term average. And I'm measuring where's the price in relation to that, and you would create a chart by oscillating it. The zero line being the average, which adjusts monthly or quarterly, whatever. And you plot the bars, and you end up with a different visual picture than when you see the price chart. It's price versus its own momentum. The rationale for that is this, aside from the fact that it gives you a different picture, and momentum almost always turns before price does, is that when you measure something in dollars, whether you're measuring stocks in euros or dollars or yen or whatever, it's a plastic unit. It's a piece of rubber. In other words, your unit isn't objective. It changes its real value year by year, decade by decade. So if you bought a stock at $10 and 10 years later it's 20, you're not up $10. You're about flat because the money growth has been about that much. So it's distorted. By taking the dollar price of the asset and oscillating against the dynamic that's created by the asset itself, namely its movement, up or down. Some things are dull. Some markets go sideways, therefore their momentum is basically flat and is reflected as such. But the speed of movement in that moving average, whether up or down, is mostly caused not by the degradation in the money unit, but by the movement of the asset. So by measuring by momentum, pardon me for getting confusing here, to some extent you're taking a step away from merely measuring it by the decaying money unit. You're measuring it by a dynamic that is set by the asset itself. Yes, it's still measured in dollars or yen, but to some extent, you've taken a step away. Therefore, it's a better technical view of that asset instead of just by using the rubber yardstick of the dollar or the yen. And it gives us a different picture. And almost always it'll tell you there's a top or a bottom before you can see it on the price chart. Okay, so that's why we use it.
Okay, yeah, that's really helpful, and I'm sure you were able to see, the momentum behind gold and such before we saw these significant price rises, especially in the miners and such. And so, I mean, that's a helpful metric. Well, could you plug the audience with where they can connect with some of your work and access some of these reports and such?
Oliver MSA for Momentum Structural Analysis, and request some free samples if you'd like. But the site explains in pretty good depth our unorthodox method, and also has a lot of our archived reports, especially about the stock market tops, bottoms, etc. So explore, see what you think of it. If you want some samples, request. We look at all four major asset categories. It's very important. You can't just put your eyeglass on and look at gold or the stock market. These things are impacting each other, so it's very important to know what the heck's going on in that category and that category.
Yeah, thank you for coming on the show. And you all be sure to hit the subscribe button. Love to have your support. And Michael, look forward to having you back on.
Thank you, Darryl.